Well, in markets, they say always focus on not where the puck has moved, but where the puck would move. So while we can talk about the year 2024 and talk about twists and turns, peaks and turfs, we can talk about outperformance and underperformance, what did well, what has underperformed. But that's history now. What really matters that as we roll into 2025, what are the factors which are at play? The script of how 2025 will move, what really would decide that? What are the ingredients in the melting pot, which in a sense will differentiate your portfolio, what you should focus on, and more importantly, what you should avoid. Now, to answer all that and much more, I have with me Prashant Khemka. We've always interacted with each other, but we've interacted with each other on Zoom or via video phone. This time, he's here in India for a holiday, and we've taken the liberty to really take some time off in his holiday and have a chat on Outlook 2025. So this is not the AI version, right? That's the real you who's come to India, and we're not talking on a Zoom, right?
Thank you, Nikunj, for having me here.
Great pleasure. पता नहीं लगता कौन किधर बैठा है.
Absolutely. One company actually did a AI-based CEO call, and then after the first introduction and all 20-minute introduction, they said this was my digital clone speaking. So it was amazing.
So how do we know it's the real you? 20 minutes from now, we can also reveal that.
So far, AI hasn't gone down to, cloning ordinary people. They're still cloning the CEOs and investment gurus. So we are safe right now.
Okay. So I'll not get into this myopic, analysis of what will happen in the short term. I won't get into a favorite question, which is that what to buy in the medium term. Let's talk about what could influence the script of the market in next 12 months in terms of mega trends, positioning, valuations, and flows. So what do you want to start with?
Certainly, Nikunj. First, let me just say how we approach investing. First of all, I've always said that fixed income is, guaranteed loss of real wealth. So equities is where money is made. So that's one decision that we made personally or firm-wide as a choice of what asset classes we offer. That decision is there. So the game is to outperform the market. Market, we believe, over time gives low double-digit returns in rupee terms. And idea is how much can we outperform by. Now that outperformance, we believe, comes from stock selection, not from top-down macro bets. And that stock picking opportunities are across board in almost every sector, every market cap segment. Yes, alpha potential is higher in small caps and mid caps because the inefficiency is higher. And then there are certain sectors which we believe are more alpha rich. So structurally, we tend to have higher allocation, and it's no different at this time, in sectors like healthcare, private sector financials, including not just banks, NBFCs, but also capital market intermediaries. And then in select industrials, also IT sector. So these four and consumption. So today as well, these 5 sectors collectively would be more heavily represented in the market. We still have other sectors in the portfolio, but these 5 sectors is where we continue to find most alpha opportunities over the next 12 months.
The way you've historically invested is that you've always looked at the quality of earnings. You've always looked at cash flow. You've always looked at predictability. Now, some would say that the good end of the market, which is the quality companies, companies that are generating a lot of cash, companies which in a sense have high return ratios, those are trading at the higher end of the valuation, be it consumer, be it healthcare, be it FMCG, or be it, well, not banks, but be it, let's say, even manufacturing names. How would you defend that?
Certainly. So couple of things I'd like to know. First, the fundamental truth that we do believe in, and I think I've so far not found anyone who's objected to it, is that valuation is nothing but present value of future cash flows. Yeah, earnings multiple, EBITDA multiple, these are all thumb rules that people can use, but value of any project or business is present value of future cash flows. So yes, we are very cash flow focused, and we look at cash flow based valuation. Yeah? So many companies might on PE multiple look expensive, but on cash flow multiple are not much different from other companies which on PE multiple might look much lower priced. Second, what you mentioned about predictability of cash flows, I'd like to add a nuance there. Predictability, yes, but of how much would we as minority shareholders get of the cash flows? The cash flows can be volatile, as is the case with industrial companies, and we are fine with those. But when governance is not of adequate quality, then it becomes near impossible to predict how much of the cash flows generated in any year or over time would we as minority shareholders receive, because there would be leakage or otherwise, poor allocation of capital or other kinds of diversions of cash flow. So I just want to add that we are not wary of, or we are not hesitant from investing in companies with very cyclical cash flows, as long as we believe we as minority shareholders will get a fair proportion of those, which again links to governance. So governance is, yes, an important focus, and valuation is very much cash flow driven.
Over the years I've seen that maybe it's a coincidence or maybe just an observation, but when the year changes, the theme changes. 2 years ago it was all about defense. 3 years ago it was all about comeback in consumers. Now suddenly it is all about solar. Next year it could be about something else. So what could be that something else, something new, which our viewers should look forward to?
See, these are certainly some of the industry trends. Won't even call them sector trends, like defense and all are part of the cyclical sector, if you will. But I think one major trend that's been, if you call it a trend, I'm searching for the right term, but let's call it trend for right now. Since December 2020 or January 21, nearly 3.5 years, till June of this year, till around the election, value was substantially outperforming quality.
What is value, if you can explain?
So see, all these index makers, be it NSE or BSE, they publish various indices. They publish quality index, they publish value index. Now, I think index makers have butchered the word value by considering low price to book or low price to earnings as value. In the context that I mentioned a few minutes ago, where value is present value of future cash flows, we don't think low price to book or low price to earnings is value. Yeah, a lot of junk. So if you tie with the second thing that I mentioned, which is predictability of cash flow, in the sense that what we would get as minority shareholders, whether we would get fair proportion or not, most of the poor governance companies tend to trade at a very low PE or price to book multiple, because the cash flows, investors are uncertain. And I've often told clients as well, the number one predictor or determinant, not predictor, the number one determinant of PE ratios or price to book ratios is not growth, but it is governance standards, perceived governance standards. But just because governance is not quantified, people focus more on earnings growth. So poor governance companies, which we loosely refer to as junk, also fall under value. Within each sector, the lowest PE, lowest price to book multiple stocks would be typically poor or weaker governance companies, and they would get clubbed in value index. Now, I'm not saying, important caveat, I'm not saying all companies in value index are poor governance, but vast majority of poor governance or junk companies would fall under value index. So last 3.5 years, they have vastly outperformed the quality index. Now, quality index is not necessarily complete opposite of value. Companies that generate very high cash flows and also are better governed, so that they are sharing those cash flows with minority shareholders, and hence their valuations are not suppressed. So high cash flow generation would mean higher PE multiple, because the cash conversion ratio is high. So PE multiple appears high, even though cash flow multiple may not be that high. But because these index makers focus on PE multiples and all, they get clubbed as quality. So a big chunk of the quality index is high cash flow generating, strong governance companies. Okay. So if you look at last 3.5 years, companies with weaker governance and low PE multiple, either because of weak governance or because of poor cash flow conversion, those have vastly outperformed companies with strong cash flow generation or conversion, and strong governance.
Why has that happened?
See, it's very, very difficult. I have seen, and I used to work at State Street Global Advisors early in my career in US for 2 years, and it's a quant shop. They had PhDs from MIT and Harvard working on a model to predict when value would perform strongly versus growth. So in US, growth and value are big two determinants of.
It's like Nasdaq and S&P.
Yeah, Nasdaq. Yes, people in US don't typically invest in just S&P. They would invest in growth manager or value manager, because the return profile can be very divergent from year to year.
Did the models predict accurately?
No, they could not. They kept searching, but you can't predict. You can understand the past in terms of what when happened, but they could not figure out a way of identify. They could not identify what led to the performance of value certain times versus growth certain times, and hence it could not be predicted. One can argue that those value stocks, which were weaker governance or were very low conversion, they just got to a price point that was so low because everything has a value. They still had some cash flow, even though governance wasn't top notch. Minority shareholders still did get some proportion of those cash flows, right? So maybe they got to a valuation level that the pendulum swung too much on one side, and hence they had a sharp outperformance of compounded about 30 percentage points for a 3.5 year period.
But the 10-year return may be still negative.
Yeah, 10-year return may be still very similar. See, over long periods of time, there's nothing to suggest that growth or quality would outperform value or vice versa. Yeah, we've never said that poor governance would underperform good governance. It may sound intuitive, but there's no historical evidence.
So there are
to make the case.
schemes which offer value. They call themselves as value investors.
Yes.
They call, or the whole unique identity of that scheme is that we like to buy something which is cheap, something which is out of fashion. We are buying fear and we are not buying fashionable.
Right.
Your identity as a fund is that we like to buy companies which have predictable cash flow.
Again, I'll just caveat, when we say predictable cash flow, I link it to good governance, where if a company is going to earn $1 billion of cash flow and we own 5% of that company on behalf of our investors, then we can be rest assured that we are entitled to $50 million of those cash flows, either in form of dividends or share buybacks or reinvestment, which in future would yield higher cash flows. But when governance is not good, company earns $1 billion. You don't know whether, even if you own 5%, whether you'll get 50 million or 40 million or 20 million or how many millions. That's the unpredictability that we consider as misgovernance, a form of manifestation of misgovernance, which is what we don't like.
So fantastically, we've identified the template. Now I'll start getting into perhaps questions which are more linked to the coming year. Now, what is your sense for 2025? Will it be value? Will it be growth?
See, from June onwards,
which is June 2024.
Yeah, June 24 onwards, post-election, I think the perception of risk amongst investors changed a little bit. There was a bit of a shock. Election outcome wasn't as positive as market people had anticipated. So what market people might have extrapolated with 99% or 5 sigma, 6 sigma kind of certainty over the next 20 years, it gave them a pause to rethink that maybe it's not as risk-free progression for the next 20 years. Yeah, so since then, what we have seen is value has stopped outperforming. It's not that quality has massively outperformed or anything. I think over the last 6 months or so, quality might have outperformed by 2 percentage points or 3 percentage points. Whereas, as I was saying, for the 3.5 years, value was outperforming quality by 25 to 30% a year.
Understood.
And annualized, yeah. So now they are more even keel. For our own sake, because of our biases in the way we invest, I hope this is more structural and it's not an aberration in a much longer value cycle, if you will. And hopefully we have a more balanced year going forward. If anything, we would love to have quality do better than value going forward, because there are structural biases in our portfolio. No matter what we do, we would tend to have a quality bias in our portfolio. As much as we try to mitigate that bias, because we don't like volatility of performance due to these value or quality moving stronger or weaker, we would structurally have more mid and small cap, and we would structurally have more quality in the portfolio.
Okay. Now let's look at the outperformance. The outperformance in last 3 years, like you said, has been with value. But within value, the buzzword was PSUs.
Yes.
How would you define PSU stocks? Are they growth? Are they value? Because they are growing. Defense companies are growing, railway companies are growing, metal companies are growing. So as a fund manager, when you look at PSUs, how would you define them? Value, growth, or
See,
both?
again, you can't paint the whole segment with one brush. Where they fall in the indices, they tend to fall predominantly in the value indices, yeah, because the multiples are lower than their private counterparts. Yeah. Now, there are many of these PSUs which are performing very well and are growing in line with their private sector peers. And yet there are other segments like banking. Overall, if you see, PSU banking has grown at a slower pace over the last 20 years than the private sector peers. Whatever may be the reason, the private players started with a lower base and whatnot.
So you've never bought a PSU?
We do own PSUs, and we have, and I've been, professionally investing at my prior firm or now for coming up to 18 years in India. And we have, for most part, majority of these 18 years, we have owned PSUs. Yes, we may not own them in as big a proportion as the benchmark.
Okay.
But there are from time to time very attractive opportunities within PSUs, and otherwise also from a risk management perspective, we do tend to own PSUs in the portfolio as well.
The other sector which has done exceptionally well this year, and again it has bewildered some, it has surprised a lot, is IT. There is a lot of talk about AI. We're talking about the AI version of Prashant Khemka. This is a sector where growth has plateaued. This is a sector where disruption is real. Yet the IT index is not far away from its all-time high. There is no growth, but yet the sector has done well. Why is that?
So I think there is a bit of a misperception on both growth and disruption.
Okay.
Yeah, and I was, first of all, this sector, IT, information technology is prone to disruption. There will always be some things new, a lot of things that are coming up new, and anytime there is something new, people would be prone to think, oh, this is a disruption, this is a disruption. Yeah. So if you look at over the last 25, since the turn of the century, Y2K was supposed to be the death knell for Indian IT industry. Yeah. Then global financial crisis was supposed to cripple them. Yeah. And then there was this whole cloud migration.
SMAC.
Yeah, SMAC at that time. Yeah, now we call AI. So the acronyms keep changing. Yeah. So the cloud, and then there was digital, and now there is AI. If you look at the industry, how it has progressed through time, each time they've adapted, and oftentimes they've turned or converted the challenge into an opportunity. Yeah. If you step back and think of why that is so, in my view, and having invested in US market, managed money there for 8 years and spoken to, interacted with so many of the largest of the companies, including from JP Morgan in banking to other sectors, they basically have a fixed IT budget. It's not that if you deliver them savings, IT budget as a percentage of revenues would go down from 6% to 3%. Their existing spend might go down from 6 to 3 or 2 or whatever, but they have a list of hundreds of projects which are waiting in the pipeline to be taken up if there are any savings or any room to spend more. So there's continuously, it's like the chip. If one would have thought, when there were whatever, now you have this mode 7, mode 3, and now nano mode 1 that TSMC is producing. I don't know which law it is called, Moore's law or something. If you were to think, one chip would be able to process, like there was a supercomputer earlier the size of this room, and now the phone is more powerful than that supercomputer. If one were to think, all that capability would be in this one phone, then why would you require all these different processing capacities and all? But as this capacity is expanded, the needs for those capacities also exponentially increase.
Demand, desire,
increase. So IT spend would continue to grow if you find more efficient ways of doing what you're doing right now. You'll find other ways of other projects. They're waiting in queue already. And if one competitor, if one global bank implements something that gives them even a slightest of the edge compared to competition, each one of the competition is bound to try hard to catch up with them and commit all this. And on growth, see, IT is the only sector which talks and guides in terms of dollars. NASSCOM gives dollar projections. So 6 to 7 to 8% dollar growth is equivalent to 3 to 4% higher in rupee terms. So 7% dollar growth is equivalent to 10 to 11% rupee growth, which isn't bad at all.
Which is higher than India's GDP.
Sorry?
Which is higher than India's GDP growth.
Yeah, or similar to, or a smidgen higher. So I think when you look at IT services rupee growth, it's not much different from the overall market growth. On top of that, the cash flow conversion is extremely high, and hence the multiples, the valuations are more attractive than several other sectors. Plus, governance standards in the industry are by and large very strong.
They always say that focus on what is in the price, which is that if you buy a great business at a bad price, it's not going to make money for shareholders.
Absolutely.
So what do you think from a market standpoint is in the price, and where do you think in 2025 we are in for positive as well as negative surprise?
Overall market.
Overall market.
So see, one important thing we believe in is that you can't predict the market, and market you have to take it as at fair value.
Always.
Always is at fair value. If tomorrow it drops 20%, it's fair value with all the news incorporated, and if tomorrow it's up. So COVID, when it dropped dramatically 30%, it was at fair value then, and when it revived 30, 40, 50% and higher, that again is fair value because it's a dynamic world. Nobody could have predicted COVID, and nobody could have predicted in a month or two with any degree of certainty that a cure would be found for COVID. Market anticipates that far better. It doesn't have a perfect 2020 vision into the future forever, but it looks beyond the horizon much earlier than market participants can look at. So fairly valued market, which means in India's context, we believe market would deliver low double-digit returns over the next 12 months. It's like any year you ask me, pretty much I'll give the same answer, low double-digit return. But it's like if you ask me if I'm going to flip a coin 10 times, how many heads and how many tails do you predict, Prashant? I'll always say 5-5. The answer may be 8-2, 7-3, or even 10-0. But that is past. That has no bearing. If you flip once 10 times and it turns out to be 8-2 heads, next 10 it should be still 5-5, the prediction. Kohli, by the way, lost 13 tosses in a row. Doesn't mean he has a knack for losing tosses. He still, the next was 50-50 odd. So that's how I would say market return double digit is appropriate expectation. The tilt, the bias is positive for me, largely, variety of reasons, but Trump's election is positive for US market. US market is 70% of global market cap. It is positive for US corporate earnings, and that has a big pull, uplifting pull on global markets, that being such a large market. And India in particular, I think in the Trump framework, if countries like China are on the receiving end, India somewhat on the margin stands to benefit. And so in November, the US outcome and as well as the state election outcome in India, both are supportive of a positive undertone to the market in our view.
Okay. Where do you think markets on the other side are pricing in, like you said, 5-10 years of terminal growth which may not be the reality? Which end of the market? Is it FMCG? Is it cyclicals? Is it capex? Where is that happening?
So there are segments of the market
which have become Humpty Dumpty.
Which were to a greater extent till few months ago, and they have seen some correction. And I think again, not each company within that sector, But yes, sectors like or companies exposed to industries like railways, defense, some of the deep cyclicals and manufacturing, they are extrapolating not only very high growth for a very long period of time, but also extrapolating, more importantly, they're extrapolating that the same set of players would capture that opportunity. Because many of these companies are companies which don't have strong, defensible, sustainable, competitive advantage. They find themselves in a position where all of a sudden the opportunity set has exploded. And yes, they are growing at very hyper rates. But because there's no strong competitive advantage, the industry would attract new players. And so if the industry is going to grow from 1,000 to say 10,000, it's not necessary that all the players who make up that 1,000 will reach to 10,000. The new entrants might take more than half of that some future years, 10,000. So on those two counts, I think many of these sectors which don't have strong defensible business models but have seen hyper growth, their valuations are way ahead of themselves even now.
Okay. I'll use consumer tech and fintech just as a segment to represent to capture your thoughts here. You have a large position in a consumer tech company. It's in public domain, so I'll share it with the public, Zomato. Now, you're a big votary of free cash flows, but when you invested, let's say, in some of these consumer tech and fintech companies, they were loss-making. Cash flows would be unpredictable because they're expanding. So what prompted you to change your framework, which is centered around cash flow, when you invested in this consumer tech and fintech companies? That's
excellent question. Excellent question. I've got this numerous times.
Okay.
So see, when we say focus on cash flows, it's not necessarily just cash flow of this year. It is, as I was saying earlier, value is present value of future cash flows.
Of course.
Otherwise, if you just look at this year, you won't be able to invest in so many companies. In fact, Warren Buffett himself has said that he missed out on Walmart because it wasn't generating cash flow at that time. But present value of future cash flows was still very huge for Walmart. So we are, and obviously you make mistakes as well, but we do believe not only the company that you cited, but there are many other companies in this sector and in other sectors which may not be generating cash flows today, but have very strong prospects for cash flow growth going into future. And it's not that's the first time it's going to happen. This playbook has played out across the world. So I was there investing in the US market through the dot-com bubble in 2000. Yeah, day one investor in several of those digital that time used to be referred to as dot-com companies. Yes. So many of those didn't make any money. Amazon didn't make any money. In fact, Amazon has been my biggest miss in my career. I didn't ever invest there.
It was a loss-making company for a long time.
It was loss-making for a long period of time, and it seemed like the more they grow, the more losses they make. So where is the operating leverage? So that one we missed. But yes, Google and others, which were loss-making at some point in time, they are now generating. They are the fangs of the Magnificent Seven or whatnot of today. So a big lesson, if there was, if someone did make a mistake at that time to only invest in free cash flow generating companies, a big lesson through that time period would have been, it's not the cash flow of today that matters, it's the cash flow, present value of future cash flows that's matters.
Like I said, focus on where the puck will move.
Exactly. So where it is going to move in future, that is most important. And not just US, then you look at Korea, you look at China. These are all countries and having, so several years have been investing in emerging markets countries. And one of the reasons that we, and this company you mentioned, we have been in a way beneficiary for much longer because of the parent, if you will, which we've been invested in for many years. And one of the reasons that we found that compelling was due to the value that was being created in investee companies. And when you compare to the value creation in similar businesses who had the similar competitive edge, first mover advantage and other strong management execution in countries like China and Korea, humongous wealth has been created in companies where cash flows are negative for many years initially, but then they have a huge turnaround in cash flow due to the strength of the business model.
I'll extend my appointment by another 5 minutes, but I'll try to weave in perhaps 3 or 4 questions. As an investor, when you look at the way how India has evolved, who would have thought digital payment would become that large? Who would have thought even a company like Zomato, which got incorporated or incubated in 2010 will be part of the Sensex. Who would have thought that IT services would be as high as what the oil, Aramco
Absolutely.
export is? Where do you see outsize changes happening in businesses, and where you would say that they are looking small today, but if we are in 2030, they are going to be the serious compounders? 5 years out, where do you see this large move happening which nobody is anticipating?
So I think just what we were discussing just now, that still has to, we are still in very early stages. Again, I am not saying that the same companies would necessarily capture the whole opportunity, but if you look at this whole new age company space or digital space, in US this whole process started in the late 90s, mid to late 90s, with the advent of internet in the mid 90s. And the initial companies were Yahoo's, Netscapes, and so on and so forth. And 2000 was the huge bubble and the collapse, and then they rebounded. And it's been under process now for 30 years in the US, close to 30 years. Even in several of the emerging markets like China and Korea, this has been underway now for nearly 2 decades. Yeah? In India, we are still in very early stages with very few companies. If you were to count now, you won't be able to count, even a dozen of those. Whereas in most emerging, a country like China, you might be able to count 100 plus of those. Obviously, US has hundreds of them, if not thousands. So it's bound to, this space is bound to see a huge explosion of companies and business models over the next 5, 10 years or whatever, 3 years, whatever time frame you see. As a proportion of the index, is bound to multiply from whatever low single digit it is today to first double digit and then potentially 20+%, as it is in many of these countries. So that is one area I would say would be a very exciting place for stock pickers. It's an area which gives rise to very entrenched and strong viewpoints on both sides of the aisle. Valuation is so expensive, the business doesn't make sense, this and that, and there'll be a lot of turmoil. A lot of businesses would go under as well. Yeah, but that is the excitement of stock picking. If you are able to identify the winners in those, the payoff can be humongous.
My last question is that I'll recap 2024, and what really dominated market mood was elections. Then it was IPOs, and then it was the SIP flows or liquidity. What to your mind could be that big calendar event for 2025 which could inject that element of volatility?
Very hard to say, Nikunj, if not impossible to say. I would say very hard to say. At this point, if you ask me, the one person I can think of is Mr. Trump, President Trump. He's known to be a character who, going by his first presidency, always in limelight. From a global perspective, he presumes, I think somewhere in January, he takes charge. So that's a source of potential volatility for global equity markets. And also for India to some extent.
We had Jim O'Neill on one of our shows, and I said, what do you expect from Donald Trump? He said, does Donald Trump know what he will do? So without getting into specifics of what he may do, what he may not do, but that is an event to watch out for in terms of how things would progress.
Yes.
If Prashant Khemka of 2025 has to meet Prashant Khemka of 2000 when you were investing in global .com companies, and if you have to perhaps whisper a learning of 2025 to 2020, what is that big learning where you've evolved as an investor over the years?
So I've only learned from mistakes. I'm very poorly read, haven't actually read a single, other than corporate valuation book. So I would say the biggest learning has been what we spoke about earlier, governance. If I had not invested in companies over this 25 years where which ended up being very misgoverned, and I underestimated the importance of governance. It would have saved a lot of money for my clients, and further contributed to performance.
And governance is nothing else but where you have to judge the, like I say in Hindi, niyat of the promoter.
Bilkul.
How much are they ready to share their wealth with minority shareholders.
Absolutely. And you have to think of it as if you are going into business, would you go into business with this person as partner?
So that's a great one. I think that's a great learning for me. And so nice to meet you in person. We've always interacted online, but so nice that you could join us.
My pleasure, Nikunj. Thanks for having me here.
And really hoping that in 2025 we will meet you more online or more offline and less online.
I hope so too.
Thank you very much.
If you like this video, then like, share and subscribe to ET Now.